7.3. That is the number. 78.95 million ounces of registered silver on COMEX. 429 million ounces of paper obligations sitting on top of it. 7.3 paper claims for every single ounce available for delivery. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold is at $4,400. Silver is at $68. And the leverage ratio underneath this market is sitting near its breaking point. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, COMEX Silver. Open interest stands at 429 million ounces. Registered inventory, the only silver that can actually be delivered against those contracts, sits at 78.95 million ounces. Divide those two numbers and you get 5.4 times leverage on total open interest. Filter that down to front-month April deliverable contracts against registered stock using current CME data modeling, and the effective leverage ratio hits 7.3 times. The COMEX Stress Index, a composite measure derived directly from CME's own published data, stood at 84 out of 100 as of mid-March, near its all-time high. This is not a conspiracy metric. It is a structural measurement, 7.3 paper claims per ounce of real metal. The market is functioning on a single assumption, that the overwhelming majority of futures holders will roll, cash settle, or close before demanding delivery. The moment that assumption is stress-tested, as it was in January 2026 when 33.45 million ounces were physically withdrawn from COMEX in 7 days, the paper price becomes untethered from physical reality. 7 days, 33 million ounces. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full structural picture, consider this. In January 2026, 33.45 million ounces of silver left COMEX in a single week. Registered inventory at that point was already stressed. It has not recovered. Now let's build the full picture because the 7.3 leverage ratio does not exist in a vacuum. CME Group's own published data shows total silver open interest at 429 million ounces. Registered silver, the deliverable category, not eligible, not warehouse total, is 78.95 million ounces. The January 2026 withdrawal event pulled 33.45 million ounces in 7 trading days. That single event represented 42% of current registered inventory, moving in less than 2 weeks. Shanghai Silver Exchange Physical is trading at approximately $4 to $7 per ounce above COMEX, a 6 to 10% premium that reflects genuine supply tightness in Asia. Under normal arbitrage conditions, traders would ship silver from COMEX warehouses to Shanghai to capture that premium. China's strategic reclassification of silver as a critical industrial material and its export restrictions have broken that arbitrage mechanism. The result is 2 separate price realities for the same metal. Western paper prices declining, Asian physical prices holding firm. The rate of registered inventory drawdown is not slowing. It is compounding. The data is doing the talking. The ones who have been called alarmists for pointing to COMEX structure for the past 18 months, they are not saying much right now. And here is what makes that picture even harder to ignore. JP Morgan maintains a gold year-end target of $6,300 per ounce. Current gold spot is $4,388 to $4,414. That is a 35 to 40% gap between the largest institutional price target on record and current spot. At the same time, fast money is net short silver on a carry-adjusted basis, actively pressuring spot lower. Physical accumulators, sovereign wealth funds, central banks, and industrial users with long supply contracts are on the other side of that trade. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. The structural picture is one question. The timing is a completely separate question. Anyone who claims to know the timing is selling something. What the data tells you is the magnitude of the risk when the stress event occurs, not when it occurs. Now the macro variable, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not talking about. 21 million barrels per day. That is the volume of global oil supply transiting the Strait of Hormuz. Iran controls the access architecture around that strait. With DXY at 99.35 and 10-year Treasury yields at 4.37 to 4.42%, Both gold and silver are facing macro headwinds from elevated real yields, near their highest levels since 2007. The Fed is holding at 3.5 to 3.75%. Zero rate cuts are priced for 2026. Non-yielding assets like gold and silver face structural suppression in a high real yield environment. Markets are still pricing a contained Iran scenario. Look at DXY at 99.35 and tell me what probability you put on that containment holding. When markets start pricing the reality of what Iran's posture actually implies for Hormuz oil flow, gold reprices higher, silver reprices higher, energy reprices higher. That is the historical pattern. Every time a credible Hormuz disruption scenario has materialized, it has not been different yet. Central banks in Turkey, China, and India are maintaining structurally intact physical gold accumulation programs regardless of the Iran variable. That sovereign bid does not disappear when futures markets sell off. It absorbs the selling. Gold Western spot at $4,388 to $4,414. Shanghai physical silver at approximately $4 to $7 above COMEX spot of $67.34 to $69.28. Short-term picture. Honest, raw assessment. Gold is down sharply from its January peak near $5,600. That correction was driven by institutional ETF outflows and the macro suppression of elevated real yields. The key level that resolves the picture is DXY below 98. If DXY breaks below 98 and holds, gold reclaims $5,000, silver reclaims $90. If DXY holds above 101 and real yields stay elevated through Q2, gold tests $4,000, silver tests $61. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold or silver does tomorrow. Nobody can. If you think you know, good for you. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides. Not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY holds above 101, real yields stay elevated through Q2, and silver tests $61 as institutional selling continues. April COMEX delivery resolves smoothly with open interest rolling without a stress event, removing the immediate squeeze trigger. ETF outflows in gold accelerate as retail sentiment deteriorates, pulling spot toward $4,000. The bull case is equally real. The 7.3 times leverage ratio faces a delivery stress event in April. Physical withdrawal accelerates past January 2026 levels, and paper price snaps to physical reality. Shanghai premium widens beyond 10%, arbitrage remains broken, and Asian physical buying overwhelms Western paper selling pressure. Sovereign central bank accumulation, Turkey, China, India, continues absorbing institutional ETF outflows and reasserts the structural bid. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure is already built into the system. 7.3 times leverage, 84 out of 100 on the COMEX Stress Index, 33 million ounces withdrawn in 7 days in January, a 6 to 10% Shanghai premium that arbitrage cannot close. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group at cmegroup.com. Shanghai Futures Exchange at shfe.com.cn. Federal Reserve Economic Data at fred.stlewisfed.org. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook. Do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.